Thank you for joining us, folks. Up next, we have Kyle Floyd with Vox Royalty Corp.
Well, thanks for the kind welcome, and thanks to Bobby and the team for another great conference. It's a absolute pleasure to be with everyone here. Just to be very clear, I think it's helpful to know why a company exists and what we do before we get into the presentation. So I'm the CEO and founder of Vox Royalty Corp, started 10 years ago, and I built this business to address what I believed was one of the biggest problems in the industry that I operate in, that was the mining investment industry, in that I wanted to build a company that investors could trust over the long term and that would solve what I believe has been an issue for a very long time, which is how do you get leveraged exposure to metals, not in the context of owning a mining company. And so 10 years ago, went about building Vox Royalty Corp. We are a very simple business. We buy mining royalties all over the world that entitles us to a percentage of the revenue that these operations generate. So we are not a mining company. We take no capital exposure into the operations. Our interest is not diluted. And I'll get more into the details, but that allows us to synthesize and take advantage of everything that can go well with an operating mine and leave behind a lot of the risks. And so in turn, we believe that we are the best risk-adjusted play for leveraged commodity exposures in the world, and that's what our company was built to achieve. I will point you to the forward-looking disclaimer. Please read that at your leisure. Topical today, and we typically don't spend a lot of time talking about gold and metal prices. We don't need higher metal prices to be very successful as a business. It certainly provides great tailwinds to our business and our returns, but entirely not necessary. However, gold, as many of you would be aware, has had a very good start to the year. It is now around $2,300 an ounce, which is about up 20% for year to date. And ultimately, what I think is more interesting than talking about the price is what's actually driving that. And when you look back to the start of the Ukraine conflict and when the US government started weaponizing the dollar, it really has now created what's a tidal shift out of the US dollar. What that means long term, I don't think anyone has a crystal ball and can predict with perfect accuracy. But what I can tell you is happening definitively is that the BRICS and other central governments are now avoiding the dollar and they're buying gold. That obviously can have some pretty positive implications to what the gold price does over the long term. There's also the inflationary impact of government spending, which everyone I assume is pretty well familiar with. And so we don't need higher gold prices, but certainly topical today is a gold price that's going in the positive direction. Something unique about Vox, there are other mining royalty companies out there. There are very large mining royalty companies like Franco-Nevada that's been around for over 30 years and has about a $20 billion market cap. What's unique about us is we have what is the most relative exposure to Australia. We have the second largest holding of hard rock mining royalties on the continent, which we'll talk about later is by far and away the best mining market in the world. And interestingly, in Aussie dollar terms, gold has been at essentially consistently all-time highs for more than 4 years now. And that provides delayed tailwinds into our business, where the Aussie mining companies have been extremely well capitalized now consistently for half of a decade. Meanwhile, in North American markets, what you see is there's a very strong cyclical nature to the financing regimes or financing capability of mining companies. And so you end up with a lot of intermittent starting and stopping development on projects and less projects getting developed in totality. Meanwhile, in Australia, because the AUD gold price has been so strong, there's a lot of momentum to that industry, and it's been very consistent, and it continues to be consistent to this day. And so when you have the portfolio of royalties that we built there, that is in essence a tremendous amount of tailwinds to our business that has essentially a delayed effect, but a compounding effect as well. So I mentioned the problem that we were built to solve, and that is to get leveraged exposure to commodities. Most investors are forced or encouraged to buy junior mining companies that have ultimately what they believe will be production from millions of ounces in the ground or millions of tons. The problem is the mining industry is very complex, has an immense amount of esoteric risks, highly capital intensive and highly dilutive, and it largely underperformed most of the benchmarks that you compare a mining company to, be it the gold indices, the physical itself, and certainly the S&P 500 or the NASDAQ. Meanwhile, there has been a sector or a subsector that's well outperformed, and that's been royalty companies. And that's because good royalty companies leverage all the things that some mining companies are forced to do, which is, generally perceived as poor capital allocation. Royalty companies leverage that to our benefit and synthesize all the things that can go well with a mining operation, increases in production, increases in reserves, all of that which can be compounded by a higher metal price. Meanwhile, our royalty interest is never diluted. We never have to contribute any capital to those expansions and to that value realization process. And so ultimately, it allows us to be a very capital-light business and exposed to what is a very compounding equation in our favor of usually what's an increase in reserves, increase in production, multiplied by a higher metal price. And so our business is really very, very simple. We just buy revenue interest on operating mines or soon to be operating mines. So if a mine's doing $100 million in revenue, we're typically buying what's called a 2% net smelter returns royalty, which more or less equates to $2 million in that example. And so the great thing is we're not out there financing mining companies. We're not introducing any capital in that equation. We're finding third parties that own these royalties all over the world. Many of you would be familiar with this process in oil and gas. We're doing it over mining projects, and we have built unique competitive advantages that allow us to do this systematically and ultimately find the deepest value in our sector. So we're getting the right type of exposure, which is leverage to metal prices, fixed operating costs, fixed capital costs, exploration upside, and a lot of asset diversification and immense scalability in terms of our operating leverage. We have more than $1 million of revenue generated per employee, and that's expected to grow significantly. So it really synthesizes the things that can go well in mining, but leaves a lot of the risk and a lot of the exposures behind. So I mentioned that royalty companies have been the one subsector within the hard rock mine commodity equity sectors that's outperformed. And it's because of this factor that we get exposure to the positives that can happen, meanwhile, leaving behind a lot of the risk. And so when you look at the track record of other royalty companies that have been in the public markets for the last decade, this industry is far outperformed, and it's been magnitudes better than the miners. It's been magnitudes better than the indices, but also much better than the physical as well. And so for investors that are looking for exposure to metals, we have a large exposure to gold, but also industrial and battery metals. We believe this is the best way to generate that exposure on a risk-adjusted basis. I'll quickly go over our capital table and our balance sheet. Our business is cash flow positive. We're about $100 million market cap. We have what I believe and what I think is often overlooked is alignment of management in our board. Our management and board owe a significant amount of the business and ultimately has us focused on creating long-term shareholder value and compounding those returns. Every single day we wake up trying to increase the long-term shareholder value of this business. And I'm pleased to say within our industry, we have grown net asset value per share and cash flow per share more than any other company in our sector over the last 4 years. You'll note a couple of interesting things about our portfolio. I mentioned the Australia weighting, but over 80% of our assets are in the world's best mining jurisdictions, being Australia, Canada, and the US. And then within those jurisdictions, the very best being Nevada, Western Australia, Ontario, and Quebec. Another thing to know about our portfolio is we focus on buying assets that are anywhere from 6 to 36 months out from production. The reason why we do that is it allows us to target where we can find the deepest value with the lowest risk. It's not to say that our asset acquisition process is without risk, but we have a team of mining engineers and geologists that are constantly scanning the globe for interesting developments on assets. We then go into what is the world's largest proprietary database of third-party mining royalties to see if royalties exist over this project. And then we get in touch with this disparate and eclectic group of owners of mining royalties all over the world. So these individuals and parties, they're not the operators of the mines. They're people, they're companies that used to own the mining rights typically, and they on-sold those rights for a royalty and usually cash. They hold the royalty back. And ultimately, those are the royalties that we go find all around the world. And so what differentiates us versus essentially every other royalty company in the world is that in 2019, we bought the world's largest proprietary database of mining royalties. So it was a company called Mineral Royalties Online. We were in the process of building our own database to understand where royalties were and who owned them to give us a leg up on the competition. This group was a little farther ahead than us, We ultimately bought this business in 2019 for $2.1 million, which at the time felt like the most expensive acquisition we had ever done as a company because we weren't actually buying royalties. We were just buying a capability to find better value. And since that point, the combination of that database and also the synergies of bringing in like-minded people that had the right skill sets, we've led the world in terms of third-party royalty acquisitions. We've completed over 25 separate acquisitions bringing in royalties over the last 5 years. And what matters most is over that coincidental time period, we've created the most value per share in buying these assets. The other critical part of our team and our process is that we have a technical capability on the front line. So it's mining engineers and geologists that are able to understand both the technical risks and the upsides of these assets, so that our investor base does not have to. So for investors looking for exposure, and the risk is that it's very esoteric, this being the mining industry, there's challenges, there's risks that are just uncertain if you're not a mining engineer or a geologist. And so we combine that technical capability on the front lines of our business, and that is what underpins our due diligence efforts. That's all internal, and that's all shareholders in the business that view the capital that's going out the door as our own capital, and very aligned in that mission. And then the other key leg of the stool is the database and the process around finding these assets globally, which allows us to find very, very deep value in this sector, and ultimately generate the shareholder returns that we have and that we expect to continue to generate in the future. I mentioned the database. This is a snapshot of what it looks like. It does give us an edge, both in terms of understanding where these royalties are globally, who owns these royalties, and then also speed and efficiency. So when we see something that we really like around a certain mining asset, we're able to see if there's a royalty over this project and who owns that royalty very, very quickly. And that combines to give us an edge in ultimately securing assets systematically at very, very good value. This is a quick global snapshot of our portfolio. As I mentioned earlier, we're the second largest holder of hard rock mining royalties in Australia, which is the best mining jurisdiction as a whole in the world. We have 6 currently producing assets. We have 20 assets that are in the late stages of development, and that ultimately we think will be in production over the next 3 to 5 years. And that is what creates the growth in our business is, well, there's really 2 key facets. One is expansion of existing projects and then new projects coming online and producing revenue. And so I believe we have one of the most exciting portfolios in that capacity in terms of growth, and that's organic. That's what's in the portfolio now. So we don't have to pay anything for those royalties, that we will realize revenue growth without essentially our business or employees having to put resources out. So that's the beauty of being a royalty company, is that to sustain and grow revenue, at some point employees become non-essential in that equation if you don't want to grow the business. So all the revenue that we bring in can essentially be very close to net cash flow. This is, apologies for that. That's not me stomping on the ground, but it's important to point out our track record. This business is competitive. There are other companies looking to buy third-party mining royalties. In fact, more so than ever, there's been a lot of investors and a lot of private equity that has done very well in hydrocarbon royalties and is looking to move into the sector. Ultimately, that will work to our advantage in that it's increasing the value of mining royalties, but they're also paying very high prices. The typical mining royalty, if it's producing, sells for around 20 times royalty revenue, and anywhere from 1.5 to 2 times its NPV. So the return profile of most of our peers would not resemble what's on the screen and some of our snapshots. To put this in broader context, the 9 assets enter production. By midpoint of next year, we expect to be paid back on all 9 of those assets on an average payback ratio of about 2.6 years. The industry equates to typically between 10 and 15 years for payback on a mining royalty. So it puts in context our ability to source these assets at very dislocated values and do that systematically and repeatedly for the benefit of our investors. One of the things that we look for and what is really critical in our industry is we have major mining companies operating these assets. That means you have better operators. That means they're better projects. They're better capitalized. Ultimately, they have lower risk and more upside. And so it's something that we really target. Our operations are usually or typically not run by small emerging companies that have those types of risks. So we're able to really de-risk the assets that we're buying while also maintaining just as much, if not more, upside by quality of the asset and also quality of the operator. We have essentially the who's who of the large mining operators in Australia running most of the assets that we have royalties over. This gives you an idea of where the business is, where it's going. Again, our growth is driven by two key facets. One is expansions of existing projects that are already in production. I'm pleased to say we've had a couple assets undergo major expansions. And then second is new assets coming online. We have grown revenue over the last 4 years over 360%. And also, just as importantly, cash flow per share significantly as well, 130% cash flow per share growth in each of the last 2 consecutive years. We do pay a small dividend that's already grown 20% from when we inaugurated that dividend 2 years ago. That's been on the back of very strong revenue and cash flow growth. Meanwhile, our share price has been pretty stagnant, and some macro reasons for that. Investors rightly predicted that there would be significant cost inflation on mining companies. That being said, it kind of capital indiscriminately left the sector, where I think it should have rotated into royalty companies because we're taking pure top line interests in these assets. We're not responsible for any of the ongoing costs that are exposed to inflation. And so, yeah, I believe it's created a big opportunity for investors that are looking for this type of exposure. We're going to continue building our business the way that we have historically with what we believe are the best returns on a risk-adjusted basis in the industry. So why Vox? Why do we think that we're such an attractive investment with how we're positioned today? We have one of the only competitive advantages in the sector. We continue to demonstrate that we have a track record of acquiring great assets at great valuations. And ultimately, we have over 100 million gold equivalent ounces covered under royalty coverage at an average rate of about 1.25%. That's more than $2 billion worth of metal that we believe will ultimately be produced, that we contribute none of the capital to bringing that out of the ground and realizing on that metal at the end of the day. So we're exceedingly well positioned. We think that there will be a tailwind to metal prices for decades to come. There frankly is not enough supply capacity or capacity to grow supply to meet what we believe is the coming demand, both on the precious metal side of the equation and then also the battery and industrial metal side of the equation. So we believe we're a very unique business in terms of the exposure that we can provide to investors with the right type of risk-adjusted returns basis. So with that, that'll conclude the prepared remarks, and I'd be happy to open it up to any Q&A. Yes. Yep. So I'll work backwards on the questions. Last question was, what's our operating leverage essentially of the business? Our cash costs of running the business are about $5 million. Meanwhile, our revenue is about $12.3 million for 2023. One of the questions also was, what's the average mine life of our projects? And that, that's a technical feature of our portfolio that's very strong. For what's in production now, it's between 10 and 12 years. But what's happening is the miners are actively drilling these assets out and increasing the resource base, and ultimately we believe will be increasing the reserve base that extends mine life. And so with the major royalty companies, they trade at about 2 times net present value, which to a lot of us in this room would sound crazy. The reason for that is on a pure reserves basis today, they're expecting that there's at least a doubling of reserves over time. So drilling into hard rock is very expensive. So mining companies will go prove out 10 years of production, and then as they're cash flowing and as they are deeper into production, they'll go prove out more reserves. So the difference between hard rock mining royalties and hydrocarbon royalties, one of them is very modular increases for mining royalties and the increase in reserves, versus hydrocarbons. When you drilling out a reservoir is typically less costly and a little bit more simple. And then also that depletion curve is different, where there's rapid depletion in the hydrocarbon sector versus mining companies typically have that modular expansion curve, and it ultimately increases optionality and increases the value of mining royalties. So that's one key difference between the two. But yeah, for mine life, also within our development stage portfolio of assets, we expect to come online over the next 3 to 5 years. That mine life ticks up closer to 20 plus years. And then that we expect to be backfilled even further. The question is, what's our typical IRR? What I can tell you is we don't have a stated IRR hurdle rate. But we recently completed a facility with BMO, so we have a $25 million revolver with BMO at an 8.5% cost of debt. I would tell you that our equity cost of capital, and you could run a CAPM formula if you want and figure out a weighted average cost of capital. I think in small cap world, a lot of those are misleading. I would argue that our cost of capital was around 20 to 25% on an equity basis. So we had to make sure that our hurdle rate was something well above that. Ultimately, what we're looking for is a multiple on invested capital. So we had the track record slide open, almost almost all of our transactions have already paid us back, and the average payback ratio has been about 2.6 years, average mine life being somewhere between 10 and 12. So we don't have a fixed hurdle rate, but it's got to be something that was significantly more than our equity cost of capital. Sure. I'll answer part of that question in this forum, and if you'd like to have a one-on-one meeting, we can go into more detail. Ultimately, our fiduciary responsibility is to our shareholders, and that's one segment of our business. The other segment is that we're providing liquidity to what is generally an esoteric and illiquid asset. And we're finding royalties that sometimes the royalty holders themselves didn't even know they owned. And so we are a provider of liquidity in essentially a very illiquid market. And so we're able to take advantage of what is generally an illiquidity discount, and groups that need liquidity at various points for various reasons. So that's one of the reasons, but we can certainly talk more about that in a different forum. Yep. Yeah. So the question is, do we get exposure to new discovery potential and expansion potential within different assets, and that generally covers the land package. So our royalties, it's mixed. Sometimes they cover the entire land package and hundreds of square miles. Sometimes they're smaller. We're buying already in existing contracts, and so we're evaluating what it covers. Does it cover the whole ore body? Does it cover every discovery potential that might exist on that land package? And more often than not, it does. In some cases, it doesn't. But we've had at this point a meaningful amount of assets that have had new discoveries within the land package, which our royalty covers. So there was an iron ore operation that we bought a royalty over from this telecom company owned the royalty. Didn't even know they owned it until we approached them. It had one ore body, had one proven out pit, and then they had another discovery on that land package that we were paid the same royalty over. So yes, we're looking for assets that have that type of exposure and that type of upside, and that's one of those compounding functions that can work very well in our favor. So the question is, what are the constraints on our future growth? It's a great question. One of the things that we've worked very, very hard on within our business and with our executive team is building our competitive advantages to continue to be able to grow better than we have historically. And when I look at our pipeline, we've generated the best risk-adjusted returns in our sector now for the last 5 years. Our pipeline is actually getting better, and that's because we put so much time and energy and effort into looking towards what's our competitive advantage and how is that going to be enhanced tomorrow versus kind of basking in the returns of today. So what I would tell you is we're in the best position we've ever been as a business to continue scaling and growing our business. We have $10 million of cash on the balance sheet. We have a $25 million undrawn revolver. The goal is not to go back to the equity markets, hopefully ever. So we believe that we're going to be able to compound per share value very significantly, both in the near term and obviously over the long term. I've no more time for questions, but we are here tomorrow for one-on-ones, and I'll be hanging around for a little bit after. Thank you, everyone, for your time. I very much appreciate it.